Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026 April 3rd, and today's theme is simple. Energy shock is the tax you didn't vote for.
A tax I didn't vote for? Finally, a government program with bipartisan support. Surprise, your commute costs more.
We'll hit 5 quick stories: the Strait of Hormuz situation, Euro area inflation, JetBlue bag fees, the U.S. jobs report preview, and China's chip firms hitting record revenue. Actionable takeaways at the end. No doom, just math.
Math is fine, but can we start with the scary part? The Strait of Hormuz is basically the world's oil throat, and right now it's doing that I can't breathe thing.
What happened? CNBC reports Iran and Oman are drafting a protocol to monitor Hormuz Strait traffic, while the strait has been effectively closed since the Iran war started in late February. Markets are watching for any sign of partial reopening.
Monitor traffic is such a soothing phrase, like when your dentist says, "We'll just monitor that cavity," and then you're selling furniture to pay for a root canal.
Simple finance version. Oil is priced on marginal barrels and delivery risk. Imagine your phone charger still exists, but the only store that sells it has a door that might lock at random. Prices jump before the lock actually turns.
So we're paying for vibes, not even good vibes, war vibes. My wallet would like a refund.
Why it matters. Energy hits everything: shipping, food, flights, manufacturing. Even if you never buy a barrel of oil, you buy the consequences. Practical move. If your household budget is tight, treat fuel like a fixed bill for the next month and cut something discretionary now before it cuts you later.
Okay, Europe. How bad is it? Because every time I hear energy shock, I picture my utility bill doing parkour.
What happened? Market Pulse says Euro area inflation rose to 2.5%, mainly due to higher energy prices tied to Iran tensions, while core inflation stayed subdued. The key phrase: second-round effects may emerge over time, so the ECB is likely to respond cautiously.
So headline inflation is yelling, but core inflation is like, I'm fine, I'm totally fine, while sweating through its shirt.
Exactly. Simple version: headline inflation is the loud roommate, energy and food. Core is the quiet roommate, services and broader pricing. Central banks care a lot about the quiet roommate, because that's the one that sticks around and raises rent.
I love that the ECB is cautious. Meanwhile, I'm cautious too, by not looking at my grocery receipt.
Story 3 is the consumer version of energy shock. The New York Times reports JetBlue raised checked bag fees up to $59 for one domestic checked bag, while fuel costs soar, and it could influence other carriers under strain.
$59 to bring a bag. At this point, the airline isn't selling tickets, it's selling permission slips. Next fee, breathing cabin air, $12.
Simple finance version? When input costs jump, fuel is a huge one. Companies either eat margin, raise base prices, or unbundle into fees. Fees are sticky because they don't look like inflation in the headline ticket price, but your bank account feels the same pain.
So it's inflation in a trench coat. Hello, fellow consumers. I am not a price increase. I am a service option.
Actionable. If you fly even twice a year, run the math on an airline card, elite status, or just pack carry-on only. A single $59 fee is basically a mini index fund contribution you didn't make, so choose which one you want.
Speaking of math, the U.S. jobs report is coming. Everyone's acting like it will reveal the meaning of life, and also whether my 401k will be okay.
What happened? CNBC previews the March jobs report with projected job gains of 59,000 and unemployment holding around 4.4%. Markets care because oil-driven inflation pressure plus slowing hiring starts to look like a stagflation light setup.
I'm going to disagree with you a little. If it's only 59,000, isn't that basically the economy whispering, not screaming? Maybe everyone relaxes and we go back to brunch.
I get the instinct, but no. A smaller number can still spook markets if wages stay firm or if prior months get revised down. Think of it like your car. The engine noise might be quieter, but if the oil light is on, you don't celebrate the silence.
Fine, you've convinced me. I retract my brunch optimism. The market wants impossible certainty, and the jobs report is just a horoscope with spreadsheets.
Actionable. Don't trade the headline. If you're investing long-term, use volatility to rebalance. Top up what fell below target, trim what ran hot. If you're job hunting, the signal is keep momentum. Slower hiring means longer cycles, not zero opportunities.
Last story. China's chip firms hit record revenue, right? So should I just buy all the chips and retire on semiconductor dividends like a spicy index fund?
What happened? CNBC reports Chinese chip firms hit record high revenue, driven by AI boom demand and boosted by U.S. tech curbs that push domestic substitution. Strong top-line performance, but the story is inseparable from geopolitics and supply constraints.
So the U.S. curbs are like telling someone, you can't eat out. And they're like, cool, I just learned to cook, and now I'm opening a restaurant.
That's a decent analogy. The finance behind it. When imports get harder, local demand funnels to domestic suppliers. Revenue can surge. But investors must price in policy risk, export controls, and the possibility that today's margins are tomorrow's price war.
Here's my disagreement. You always say price in risk. I think markets don't price in risk. They rent it for the weekend and then act surprised on Monday.
Fair. Markets often underprice tail risk until they don't. Actionable. If you want AI exposure, diversify across the stack, chips, cloud, software, and across regions, and size positions so you can sleep if headlines turn hostile.
Quick recap. Oil choke point drama, Europe inflation doing the headline versus core split, airlines charging for oxygen soon, jobs report roulette, and chips making money in a geopolitical blender. Did I miss anything terrifying?
That's the day. 3 practical moves. 1. Tighten your short-term budget for fuel and travel fees. 2. Don't gamble on single data prints. Rebalance instead. 3. If you chase hot themes like AI, do it with diversification and position sizing.
And if you're feeling stressed, remember, you can't control oil, but you can control your spending and your risk. Also, pack lighter, emotionally and literally.
If this helped, subscribe for the next briefing and drop a comment. Do you think the energy shock spills into broader inflation or fades fast? Thanks for listening to BD Daily Finance News Podcast, your daily briefing on finance and investing.